All right, we are live. Thank you everyone for joining us in today's video. And Jim, good to see you, buddy.
Hey, long time to see. Good to see you.
It's been at least a week. So yeah, Jim and I were talking about what kind of video to make today. And, I make videos about our housing market, trends regarding home prices, inventory, etc. But in today's video, we're going to talk about what is the true cost of buying a house. We all know about home prices, but again, we have a lot of other costs involved in buying a house, and that's your down payment, closing costs, the cost of buying the house, and also property taxes, insurance, etc. So if you guys have any questions in today's video, just like we do for all these videos, just put question in caps, and we'll do our best to answer all your questions in today's video. The purpose of this is to provide value to you guys, so we want to make sure we answer as many of your questions as possible. We'll do this live stream just like we do for every single week on Tuesday from 3:30 p.m. To 4:30 p.m. Pacific Standard Time. So in any case, Jim, I'll kind of let you kind of start this about the true cost of homeownership. And I can also talk about, I guess, like buying house, the closing costs involved in that as well. But is there anything you want to kind of mention right off the bat here?
Yeah, there's a couple themes that I think are good themes to have for big decisions in life. One is just a general theme around what is the opportunity cost on whatever you're doing, right? A lot of people need to evaluate the pros and cons of making a financial decision to make sure they're making a great one. And the other one is, if I don't do something now, what is the cost of waiting? And those two themes are, I think, really important decisions and themes to think about, again, when you're making a big decision. So what's the opportunity cost to say yes or no to a decision? And if I say no, what is the cost of waiting relative to dollars or time, energy, money, stress, whatever those things might be that are important to you in making a big decision?
Yeah, well said, buddy. I want to give a special shout out to Kevin.
Kevin's always the first one on.
Kevin's always on. Yeah, it's great. Great to see you, buddy. He's been a follower of my channel for a long time, so I appreciate it so much, Kevin. Thank you for joining us. And then RB Alaska, we have seen him or her in previous videos as well. I've ran so many calculators on this, and yet over time, the answers get foggier rather than clear. Glad you have this. We're talking about this topic. Yeah, thank you for joining us. Yeah, because there's so many factors involved in buying a house. We have so many different loan programs. We have a VA program, FHA, conventional. And I think a lot of people think we need to put 20% down to buy a house, which is not really the case. So do you want to share your screen, Jim? I know you
Sure.
said some other things. Let me see if I can give you permission to do that.
I have no idea how to do this, so we're going to learn how to fly.
We're figuring this all out.
I think I can present.
Insurance screen cancel. Sorry, guys. We're new at this. We're trying to figure this all out.
I think I got it.
See?
Boom.
Boom. Jim Black's in the house.
You guys see this? Okay.
Yeah, we see that.
Okay. All right. So what we're looking at here is an example of a total cost analysis of buying a $400,000 home, and two options we're going to look at. We're going to compare a rent versus an FHA putting 3.5% down and a conventional loan putting 3% down. This is the great tool that I use from the Mortgage Coach and a good friend of mine, Dave Savage over there. This tool is a good way of evaluating your own personal rent versus own and some of the things that go into that process. So here in this example, I'm just using a rent example of $3,050 a month rent. That again is in the orange area over here. And I'm going to compare it against putting 3.5% down on FHA, which is the yellow chart over here, and putting down 3%. What's ironic is the difference we're going to look at in terms of what you would pay in rent over 50 months and versus what equity you'd have established in either loan for that same 50-month period of time. So the first thing we want to do is look at what goes into a mortgage payment. So this is where it'll get really interesting really quickly. When we look at a mortgage payment, we truly have about 5 or 6 categories, depending on what type of property we're buying. First and foremost, we know that the largest payment in a mortgage payment is going to be the principal and interest payment for the most part. In this example, you can see again that I'm comparing an FHA loan and a conventional loan. And in that example, we're looking at the P&I, or principal and interest payment, of $24.89 versus $25.88. The next category we're looking at is property taxes. Property taxes, as you can see, are based on the same numbers on these two examples. In most parts of California and parts of the country, we base our property taxes off 1.25% of the purchase price. So in this example, we're taking $400,000 times 1.25%, dividing that by 12 to give us a monthly payment of $416.67. The next category is right now the hottest topic, literally because of fires and floods and a lot of natural disasters throughout the country. This is known as your hazard insurance or property insurance or homeowners insurance. These are the categories that are under the most scrutiny right now from each state, with the fact that a lot of insurance companies have pulled out on some of the previous talks we've had. These payments have gone up 3 to 4x year over year, which is crazy. As I walked into this meeting today, we had one quote that was $8,000 for a property worth about $1.7 million that actually got misquoted and was $17,000, which is
What?
crazy. Yes, $17,000.
$17,000 for the year for home insurance?
Yeah. So that's over $1,100 a month, actually more than that. It's like $1,300 a month. And then what happens when you get a quote like that, a misquote from an insurance agent?
Oh, yeah.
The
Oh,
debt to
wow.
income ratios then change dramatically. The amount of the payment changes dramatically. So it has to go back through underwriting to get reevaluated.
Ouch.
Brutal.
Yeah, I mean, I pay like $135 or something per month. That's wild.
Yeah, it's wild. So that's a big category. We know that throughout the country, like for example, in Florida and California, these are just getting astronomical and getting pretty crazy.
Wow.
Yep. Another category that has to do with loan amount, less or more than 80%, are mortgage insurance payments. The mortgage insurance company requires the consumer or borrower to make a monthly payment to insure that loan because it's a higher risk loan, being over 80% combined loan to value. So in this example, you can see that with FHA and conventional, those payments aren't too far off, $2 or $3 off. Not a big difference there. So it's good to see that these payments are relatively the same. One other category that we have in this payment example also is known as HOA. Homeowners Association dues are normally fees for shared maintenance, shared space. These are normally in like things like townhome communities, subdivisions, condo projects, maybe retiree 55 and older communities. These are fees that are paid monthly that go to maintenance and utility of the property. Maybe there's a shared pool, maybe there's a shared clubhouse, that kind of stuff. So in this example, I'm just giving $200 for HOA. So what it does, it gives us a comparison at the end to show us the difference in our current rental amount, our FHA new payment, and our conventional payment. You can see, ironically, these payments are within about $100 of each other to, ironically, put down 0.5% less. Is that making sense so far to everyone?
Yeah, so FHA, the minimum down payment there is 3.5%. So Jim's using the minimum down payment for a conventional loan, which is not 20%. It's actually 3%. So yeah, interesting to see that the monthly housing payments is basically the same for a FHA versus a 3% down payment.
And the biggest difference is the base rate of the mortgage. FHA loans have a lower base rate, but they have a similar mortgage insurance rate on the monthly basis. So that's why you see the difference there in cost relative to the down payment. So let's go through here and look at closing costs now. Closing costs we want to look at are things that are paid either one time, as known as non-recurring closing costs, or reoccurring closing costs. In our example here of $400,000, we know that the down payment is $14,000 and $12,000 respectively for the equity required to buy the property. We then want to look at other items that are in this. Things like prepaid items. Prepaid items are things like property taxes put into a in-pound account, which is monthly versus paid out semi-annually, and maybe upfront prepaid items, like maybe there's a month of interest owed or an HOA fee owed, that kind of stuff. The last thing you want to be aware of is this big chunk of change right here under the FHA option known as the UFMIP. That stands for Upfront Mortgage Insurance Premium. That is built into the loan amount. So the loan amount actually is increased by that difference, because you would normally think that that difference of $6,773 would make the cash to close be significantly higher. It's not, because it's put into the lown amount. So that loan amount is higher.
Yeah,
it's finance. Exactly right. So that's an example
why
there.
I was hung up on the 3.5% down, and then the numbers you have for the loan balance, because you're including that upfront mortgage payment in that loan amount.
And that's where you'll see this 393,822 number here under FHA. You'll see that the APRs, or the effective annual percentage rates, they're very similar, even though the payment on the actual note rate is, 0.5% difference. It's only really about 0.3% difference after all the closing costs are added together. So now we want to look at, again, we all know that we want to look at the total cost of buying a property. Again, we can compare over here on the left side, the $3,050 a month in rent. We know that the FHA payment would be $3,147. We know the conventional option would be $3,285. Again, over a 50-month period of time, so about 4 years and 2 months, you would be giving up $167,000 in rent, which is worth nothing. Poof, out the window. If you were to buy using FHA, you would have saved $20,381 in overall principal reduction or equity. And the same thing here with conventional, $18,455. Again, what we want to think about in that regard is that is just from the loan amount you started with to the current balance. It's not including anything related to appreciation or potentially depreciation. But in a simple way,
go ahead, Jim.
I'd rather pay myself and have equity than not pay myself and have wasted $167,000 of money.
Yeah, so your total payment in these two examples is your principal, interest, taxes, insurance, and also your mortgage insurance as well, right? And so a portion of your total monthly payment goes to paying down your loan balance, that principal pay down that Jim's talking about, excluding any potential for home price appreciation.
Exactly right. In this analysis here too, I dive deeper. I went to view more details. Here you can see an average appreciation of 5% year over year, which is kind of an average. In a 50-month period of time, this chart shows what the real estate value would be using FHA or conventional. Obviously, you get zero value if you're renting. So in this example, again, your loan balance has gone down, right? And you have total equity of between $94,000 and $97,000. So again, you've paid $20,381 of principal and $18,455 of principal. And that has driven down your loan balance from where it was to where it is today. And that total equity you should be sitting on is this. In any of these examples you see here, we can do customized versions of this. So reach out to Jason. we can provide these total cost analysis that show you all the important factors before you make a decision.
Absolutely.
This one's
And
mind-blowing here, actually.
I was going to say, I want to mention Steve's comment because Steve's he's always a number one commenter on my channel. Question: how much does it cost to buy a house? Too dang much. He also says hello. Hey, Steve, thanks for joining us today, buddy.
Yep. So again, this is looking at a rental increase of 6%, and it's actually property appreciation of 4% in this example. I'm not taking tax into consideration because that's a bonus benefit. I didn't want to put that in here because everyone's taxes are different. But again, you can see over a 10-year period of time, these positions are almost very, very similar in nature. So it doesn't matter if you get an FHA loan or a conventional loan. In this example, ironically, they're within $100 difference, 10 years ahead if there's appreciation and you've been making your payment on time. Pretty cool.
It's pretty cool. Thanks for sharing that. One thing I'll add is that, I remember when I was a renter and my lease was becoming due, I was just kind of like scared regarding how much is my landlord going to increase my rent? And if you guys are renting, you might have that similar feeling where you budget for a certain amount per month. And, there's pros and cons about buying and renting. But the major con that gave me anxiety, frankly, when I was renting was that, my lease was going to come due in a month. How much is my rent going to be in the next term? And the upside on actually owning a house is that your principal and interest payment is fixed during the entire term of your loan. So if you have your house, you have the same loan for 30 years, that principal interest payment is going to be fixed over the life of that 30-year loan. And therefore, it's really a good hedge against inflation, whereas rents tend to go up over the long term. Whereas in owning a house, the principal interest payment is going to be fixed at least during that time frame. And in California, we also have a cap on our property tax increase as well, which I know other states do not have that, but it's really great to have that when we have huge gains of appreciation like we saw in 2020, 2021, where in California homeowners, the amount of our tax assessor values of property can only increase by 2% max per year. So if home prices increase by 20%, your home value technically is 20% higher, for example, your tax assessed value only increases by 2%. So that's also a hedge against inflation as well. That's kind of a special thing in California, which I know it's not in other states though.
Can we go to Renee's question? Because I have the answer on my screen.
Okay, cool. Yeah, I just want to give a shout out to Raymond. Thanks for joining us. And Johnny Fly, good to see you, buddy. What else we have here? Yeah, and good afternoon, Renee. Steve has a really good point. Wow, hit the like button. That's a really good idea. Thanks, buddy. And let's get to, I want to say, hey, Gail, how's it going? Good to see you. All right. Renee's question, you said?
Yeah, that one's good.
All right, cool.
Okay.
Anyone who's looking to buy, just save, and save money. Put more down and lower your payment that way. Try at least to get 20% down. That way you avoid paying mortgage insurance. So Jim, take it away. And Renee's been a long-time subscriber as well. So thank you for the question, Renee.
Thanks, Renee. So I'm going to share my screen to share why you don't have to wait for 20% down. Because in waiting for 20% down, you may be making a whole heck of a lot more payments on rent than you realize. So here I'm going to show with you guys now is my screen specifically around if I was to put down 5% or put down 20%. Can you all see this?
No, I don't think you share your screen.
Oops. I'm sorry.
You're welcome, Steve-O.
Can you guys see that now?
There he is. Got it.
Okay. This is known as the cost of waiting. This is a cost of waiting example using the same purchase price, or a little different purchase price, I should say, but putting down 5% or 20% down. If we look over here to the right side, we're going to see our current rent, $3,050 a month. If you put down 5%, your payment would be $2,908. If you put down 20%, it'd be 21.21. Well, Jim, I want to wait because I'm going to save more money and I'm going to have a lower mortgage insurance premium. Well, if you look here over a 5-year period of time, that's how long it would probably take someone to save up the additional 15% for down payment. The reason I say that is because they've been still making this $3,050 a month payment while they're trying to save more money. That makes sense. So again, they'll have spent $201,922 over 5 years, wasted money for no appreciation, no nothing, when in fact they could have been making more money in the long run off of owning a property. So again, putting down 5% gets you a payment about $32.19. So you're spending, in this example, $32.19 versus $30.50, as long as the properties are like kind, right? We need to make sure they're all apples to apples comparison. And over the course of the 5-year period of time, I'll have again saved $22,000 of paying down my loan and not wasted $201,000 on rent. So you don't need to put down 20% necessarily to make this work. Again, there will be mortgage insurance, but that mortgage insurance is much better. It's worth paying because you can get appreciation. And in that example, it's only $158 a month of mortgage insurance.
So what's your general advice for people like they're looking to buy and they don't have 5% down or they don't have 20% down? Are you saying that you would I'm sure it probably depends on their scenario, but are you saying that it might be better to put 5% down rather than waiting to save out 20% because the mortgage insurance is only, you said an example is how much, $170 per month?
Yeah, it's like the difference in mortgage insurance is about $158 a month in this example.
Got it.
So again, every situation is different, right? But it's just good to evaluate both sides of the equation. And I would rather pay myself and have equity and maybe have appreciation fluctuation versus knowing that my rent is going to absolutely nothing.
I hear you. Steve-O says another fear about renting a home is the owner can decide to sell it. Man, one of the most stressful situations I had for a client was their landlord gave my client, I think it was like 2 months to move out. And that was during a time where we had, very limited inventory levels. This is probably like 5 years ago. And it was so stressful trying to find a house in time for them to move out. Extremely stressful situation. So yeah, good comment, Steve-O. Let's see if there's a question here. You're very welcome, Renee. Our pleasure. Cindy, thanks for joining us, Cindy. Cindy joins us every week. P&I is fixed, but the TI part worries me as well as the fixed income when we buy. Yeah, absolutely. Like I mentioned, in California, our property taxes are fixed, or the increase is fixed. Whereas, areas like you're seeing areas like in Florida, for example, HOA fees, maintenance fees, insurance, and property taxes absolutely skyrocketing. So when someone's on a fixed income, I don't know how they budget each year when they're seeing big increases each and every year. Sad but true. All right. If anyone has any questions, just put question in bold. Yeah, absolutely, Steve-O. Very stressful when that happens. Supreme Action plan to throw down 20 to 40% at the end of the year should be an affordable mortgage payment in today's market.
I got a question for Supreme. Another thing besides opportunity costs and cost of waiting is to think about your blended rate on borrowing money. So I'll share my screen one more time because I'm getting good at this now. The blended rate.
You're setting yourself up for failure on that one, Jim.
Is that bad? Can you guys see this?
Oh,
okay?
wait, I spoke too soon. Jim, on it.
Does this work? Okay. So another thing to think about, this is from my friends at MBS Highway. This is Barry Habib, he's a friend of mine. I
Oh,
subscribe to
nice.
this channel, MBS Highway. So remember, blended rate is important to be aware of. People, just because you have a low mortgage rate doesn't mean you have a low blended rate. So in this example, you can see someone has an interest rate of 4% on the mortgage. Their credit cards are 24% and their car loans at 9%. We don't know the actual, dollar amounts here, but this is an example that shows the actual effective rate is 6.2% on their overall debt. So back to the question at hand with Supreme, I would want to make sure that you have a good idea as to what your blended rate is on the money that you have outstanding versus what you can pay off or invest in. So again, thinking about that is really important. So we're talking about opportunity cost of waiting, and blended rate on debt.
Yeah. And the cost of waiting of buying a GameStop, for example, GameStop went up like 75% past 2 days. Anyways, Crystal, question, given what we know at this point, was your best guess for timeline for interest to start dropping? Asking for a friend. Thank you for the question, Crystal. You guys may not be aware, but the core CPI or not the core CPI, but the CPI numbers, one of them is core CPI, is going to be announced tomorrow morning. And the direction in rates tomorrow is going to be dictated by that. And
what
in
does
general,
CPI stand for, Jason? Can you tell everyone what that means?
CPI, the Consumer Price Index. Thank you, Jim, for asking. So the Consumer Price Index. So that's what you and I pay for everyday goods and services. So take a look at that when you guys wake up. If you're in the West Coast or I think it's at 8:30 a.m. Eastern time, that report is going to get released. And then take a look at the 10-year Treasury, the yield on that to see what rates are going to be, which direction rates are going to be headed. So that's going to be an interesting one. But yeah, that's kind of a short-term tidbit regarding rates. But yeah, Jim, any thoughts regarding the timeline for interest rates to start decreasing?
So again, we talked about quantitative tightening and easing last time.
Yeah.
The Fed did announce that Fannie and Freddie are going to start buying second loans versus primary first loans. So they are trying to ease some of the pressure from the banks right now and doing that. Hopefully that lowers some of the overall rate risk for banks so they can lend at a lower rate. Because when they lend out on lines of credit or bank products, those are portfolio balance sheet loans. So if rates go higher or lower, their balance sheet is affected directly. That's what happened with Silicon Valley Bank, Signature Bank, and First Republic Bank, is they unfortunately hedged their rates incorrectly. And when rates went outside of the threshold of their hedge, they were upside down in a matter of minutes. So unfortunately, that was something that happened. So the government is trying to ease things, but they can't reverse their policy around quantitative easing. So they have to find other ways that they can do that.
Yeah, I mean, I just like broad picture too, to answer your question, Crystal, it really depends on, what happens with inflation. I really do not expect to see the CPI numbers come down well below expectations. So it doesn't appear a lot of things are really coming down. So we won't see a significant decrease in rates until we start seeing significant decreases in inflation numbers, in my opinion. Question from Maddie. Are buyers offers now including contingencies for the ability to get insurance below a particular rate? That's a really good question. I have not seen that in my neck of the woods, which is in Sacramento, but that'd be a great thing to include in an offer, especially for that buyer. Was it a buyer or refi you're working with, Jim?
It's a buyer. It's a buyer that's
Buyer, there you go.
about
Yeah.
a week away from closing. So again, there are
A week away from closing.
Yeah.
Oh man. Oh geez. Okay.
There are contracts, Maddie, that there are contract addendums for the California Association of Realtors that does speak to this. There are what's known as contingencies, like you mentioned, for loan, appraisal, property condition, and insurance. So that is a form that's now being issued. So it is something that is a big concern, right? So you normally have an insurance contingency that's a standalone item, which is important to be aware of. So yes, there are things like that, and and your agent should customize the approach because every area is different. Where I live, we have big mountain ranges and we have flood zones. So it could be a difference of one block, could be a difference of $10,000 a year in payment. Pretty crazy.
Yeah, my advice for anyone looking to buy a house, let's just say you see a house online you absolutely love, you toured it, you're thinking about placing an offer. You can reach out to your insurance agent and get a quote even before you own the house and even before you place an offer on the house. Because in this example, Jim's talking about $8,000 turned into $17,000 per year. So if you're in an area that has wildfires, flooding, hurricanes, etc., might be a good idea to get a quote ahead of time as well to kind of see what's that will look like. And I imagine your agent could potentially add something. It depends on where you live, of course, but you might be able to add something in your offer. It says, hey, here's my offer. I can have a contingency on the insurance amount to be no more than X dollars per year. You probably could do something like that. Something I honestly have not even thought about. I'm not in a earthquake zone. I'm not in a hurricane zone. And in Sacramento, we don't really have much in the way of wildfires until you get into the foothills. Really good question. Thank you for that. Let's see. And then JBF Alaska says, my costs are $2,750 to rent a $650,000 home. I'm too old for a 30-year mortgage. A 15-year would be better. I see Jim clicking away. Are you going to share some examples regarding 15
I was
years?
going to do that. I'm trying to build one right now as we're talking. So the thing to be aware with this approach, honestly, is a lower amortized term is going to always have a higher overall mortgage payment. So ironically, it doesn't matter to me how long you're going to take to pay off the loan. It's more about how comfortable you're going to be with your payments. So I would actually argue that it's better to actually have a 30-year term and have a lower payment to be able to live comfortably versus be stressed making a payment that could be twice as much, if that makes sense.
Yeah. All right. Thank you. I see some questions about inflation readings today. So I do want to touch on that. So for example, this Sear Guru, inflation today came in on the high end than expected. We are stuck with this economy. Let me share my screen with you guys because I have some thoughts regarding that. And let's see if I can do a faster job than Jim Black here.
I'm building out a
okay,
matrix
cool
as we're talking. Sorry.
And we're on the fly here, right, folks? So
I'm trying to get
this is a fantastic website, and not a paid promotion, but it's investing.com. If you just Google investing.com economic calendar, and you can see all the reports that get announced each and every day. You also can look at the week as well. So in regards to inflation numbers, let's look at PPI. So PPI, let me just click on this. Which one is I want to look at? I want to look at this one right here. So, well, let's just look at both of them. If you guys can see this. So PPI, which is what producers pay. This is inflation readings for what producers pay for the month of April. It came in at 2.2%, which is on par with expectations at 2.2%. Now, here's where I saw this initially, which I thought that rates were going to increase. But in fact, rates actually decreased slightly today, which is on Tuesday, May 14th. If you guys are watching this recorded video. So the actual reading for inflation compared to March was a gain of 0.5%. The forecast was a gain of 0.3%. So it came in hotter than expected. So I saw that. I thought, gosh, rates are going to increase today, but they did not. The reason was because of this right here. The previous reading, which was in March, actually got revised down. Let me actually go down to that. So 1 month ago, for the month of March, the PPI compared to February increased by 0.2%. Today, it got revised down to a decrease of 0.1%. So it seemed that bond or traders for bond in the bond market actually liked that, because we went from a 0.2% gain to a 0.1% decrease. So even though inflation came in hotter than expected, it appeared that and traders were more focused on this downward revision in the previous reading. So I hope that makes sense, everyone. And back to you, Jim Black.
I'm trying to fix this here. So overall, the payment difference is going to be something about, it's close to
okay. Go ahead and keep on working. Hey, Trey, thanks for joining us, buddy. Appreciate you.
It's a difference of about 72% payment to do a principal and interest 15-year loan versus a 30-year loan. So you're almost doubling your overall payment and cutting half the term. So it's substantial, and it's just good to be aware of that. So
got it. Okay, so doing a 30-year versus 15-year, your payment is basically double that. Okay.
Yep.
Yeah. I mean, in that scenario, why wouldn't someone just get a 30-year fix and then just pay down more of their principal each month?
Bingo.
They have the flexibility, right?
And on average, if you make one extra biweekly payment, or if you go biweekly payments, which means 26 payments a year versus 24 bi-monthly payments a year, you're trimming off between 4 to 6 years of the overall mortgage period at the end. So that's a good way of kind of tricking the system and saving some money on a payment hack.
All right. Yeah. So UTF key user says, yeah, with the report today, there might be a chance that Fed increases rates. Yeah, we'll have to look at. I mean, I think that a lot of people are just waiting for the CPI report, which will be posted on Wednesday. I'm actually really excited for that. When something like this happens, whatever reason, I wake up early because I want to check my phone, because it'll be 5:30 a.m. and we'll learn about this. Jim probably does not have that problem. He probably wake up early anyways.
Not because I want to.
Okay. Renee has a good question. How much would the median home loan cost once the loan matures at the current rate? Say 30 or actually, I'm not too sure if I understand the question. How much would the median home loan cost once the loan matures at the current rate?
Okay. So another way of saying this, I'm just trying to take a stab at it. Over the life of the loan, there's a thing called total interest paid, or known as TIP, TIP. On average, the total interest paid is between 65 and 75% of the original mortgage balance. So if I had $1 million loan, the total interest paid over the life of the loan would be about $1,750,000 roughly, would be the total interest I paid over that loan. I hope that's the answer, Renee, to the question. I don't know if it is or not, but it's about 75% over the life of the loan is what you're paying in interest.
Thank you, Jimmy. All right. Just see if there's any other questions here. All right.
I like Obed's question.
What's that?
Obed's question is a good one. Bermudez.
Oh, I didn't see that one.
408.
This one right here?
Yep.
Obed, you want to read it?
Sure. Does the mortgage insurance premium or private mortgage insurance go away after 20% equity is achieved, or does the seller have to refinance to get rid of that payment? So seller mean owner versus seller. Okay. So great question here. Every lender servicer is required to evaluate this on a regular basis. So they cannot put extra insurance on something once it's below either a 20% of the loan to current value or less than 80% of the original loan balance to the new loan balance. So you look at it two different ways. You look at it from current loan balance to value of property, and you look at it from original loan amount to current loan amount to determine when you can get rid of that. That is something you do with the loan servicer. So whoever's on your mortgage statement, you call them and say, hey, I'd like to get a review of my mortgage insurance. You can do it every year, basically. They're going to run their own analysis. If you have good data points or good comparable sales in your neighborhood, talk to your realtor talk to, your lender partner to see if there's anything that's sold that you can provide comps to show that it's something that's a better situation and get you out of that mortgage insurance.
Thank you, Jim.
No problem.
Trey Hall has a question. Jason, what's your opinion on these loans that disguise themselves as cash offers? Scam, too good to be true. As cash offers, are you referring to like iBuyers, for example? Or are you referring to someone who's buying a house using like a private money? Maybe you can follow up with that and we can get.
Yeah, I can answer the question. So there are a lot of financial technology and property technology companies that have been established to create a faster way of buying properties with lack of inventory. So basically, it's something to be aware of that is out there. What that normally means is that if it's all cash offer, it should mean someone with a suitcase that delivers cash. That's pretty much an all cash offer. If the contract has a box marked other financing, then it's not cash. So a lot of people are trying to compete with all cash offers by using programs that are out there that help someone buy before they sell or allow them to speed up the process. But again, you want to look at all those offers. If you're the seller, you want to make sure you vetted all the offers out with your real estate professional and maybe a loan officer. If you're a buyer, you want to make sure that you've done your homework on the product that you're getting into, because it is a loan if you're getting something financed.
Yeah, absolutely.
So it's important to know the difference.
Yeah, I took on a couple of listings recently. One hit the market Friday. I have another one hitting the market tomorrow in Natomas. But this one I have listed as a condo listed on Friday. We received an offer yesterday, all cash offer, and it was like practically like 50% of our asking price. It's a super low ball offer, a cash offer, and a company based in Sacramento, in which they didn't even look at the house. They just sent me an offer without even contacting me or even viewing the house. So there's stuff like that going around as well, which we saw more of that in like 2012, 2013, and not 2024. MVD reports, question: with rising credit card debt and the increasing inflation rate, bankruptcies will surely rise. But I feel that regardless of bankruptcy, homeowners will fight to agree to keep their houses. Agreed. I would say that if someone is strapped, they're having a financial hardship, losing their house is probably the last thing they want to do. So they'll rather, lose or have a late payment on their credit card balances, for example. But they'll do anything to keep their house intact. Some people, they're not going to be able to do that if we see a huge increase of unemployment. But I'll say this again, if we have some sort of like crisis regarding our labor market where people are losing their jobs left and right, this will be completely different compared to 2008. Back then, the government just let lenders foreclose on people. And the next time, whenever that is, I would imagine the government's going to step in and offer a new program, a revamped, mortgage loan forbearance program, for example. So that's why I see what's going to happen potentially if our labor market starts, tanking.
Yeah, and if someone has bad credit, even if you get kicked out of your house, it's going to be harder to get a rental property. So that's even more reason to stay in your property.
Yeah, true. Good question. I mean, good comment. Cindy on the tube or on YouTube. Do you know if it's common for a new builder to give a copy of the contract before you commit to buying a house? This is something I ask for my clients. I represent buyers looking to buy brand new houses, and I actually ask them, "Hey, can you give me a copy of your purchase agreement?" Because those agreements, strongly protect the builder, not home buyers. Completely different compared to what we see in California. When you buy a house in California, we use the standard California Association of Realtors contract. But when working with a builder, you actually use their own contract. And that could be over 100 pages long. I've seen 100 to 175 pages long instead of 20 pages long. And so, yeah, if you guys are looking to buy a brand new house, I strongly encourage you to not only work with an agent, but also ask for a copy of their contract as well.
Yep.
All right.
There's some
And
more. There's some more chat about mortgage insurance premiums and PMI. There are different categories of mortgage insurance. So again, I would work with your local lender to determine all of these different ones that you're looking at to determine what you have and what the options are for you. There are certain things about FHA loans that have changed in the last 5-10 years. Some of them are not as forgivable with the mortgage insurance premiums. And just again, it's case by case. I think it's important to just do your homework and talk to your lender. And again, FHA has mortgage insurance premium. They also have upfront mortgage insurance premium. Conventional does have private mortgage insurance. It's called several different things besides just PMI. There's lender paid, there's split, and there's borrower paid PMI. So just know there's a ton of different ways you can structure these in a transaction. The buyer can pay for it, the seller can pay for it, the lender can pay for it. It's a lot of different ways that happens. So
cool. Hey, Travis, thank you for joining us, buddy. Appreciate you. We edit a lot of Travis's videos too, so it's kind of cool. Anyways, yeah, real estate mindset. Travis Spencer in the house. FHA mortgage insurance does not go away unless you put 10% down and after 11 years. I don't know anything about that. Jim, anything you want to comment on that?
I would be shocked that if anyone has an FHA loan for more than 7 years nowadays.
Why is that? Just
because the rates change. Rates, if you look at the cycle of rates, they've come up and down in a 7-year cycle. So if you've been at the top one of those cycles, you've refinanced out of that loan because you don't want mortgage insurance. You know, that's what that means. If the value's there and if, you know, things are okay. So
got it. Okay. So you're saying that if someone's using a FHA loan product, chances are within 7 years, they're going to refinance and move into a conventional loan.
Yep.
Got it. Okay, cool. Mel N. Hey, Jason. Hey, Travis. Hi, chat. Happy to catch this live. Hit the like button. Yeah, thank you for your support. Appreciate that. And MVD reports, agree the government is going to have to a different approach this time around than let foreclosures flood the market. Thanks for the response. Yeah, absolutely. Our pleasure. Is Travis fishing for sharks right now while watching this live? That'd be cool. Travis lives in Houston and goes fishing for sharks. I've seen the videos. It's pretty cool. Catch and release, though. Catch and release. Let's see if there's any other questions. Renee. Last question. When do the analytics for this channel predict a $100,000 subscriber base? I just want more people to subscribe and share with friends. Thank you, Renee. I mean, appreciate your support. We just hit 98,000 subscribers a couple days ago. So we're slowly on our way to 100,000. So yeah, thank you for your support.
I think we should ask a question to the audience also down the road. When you get that mark, are you going to get a tattoo or a brand, and where's it going to go?
I was going to get a giant like YouTube red thumbnail on my chest, a tattoo. And I'll say on my lower back, we'll say 100,000 subscribers. I don't have any.
You've served over 100,000 people, like McDonald's says that about the billion served daily.
Yeah, maybe so, right? All right. Now, yeah, I don't know what I'm going to do when I hit 100,000. It'll be cool. I'll get the silver play button, which would be kind of cool thing to have. All right. Yeah, I appreciate you too. Let's talk assumable loans. We actually talked about that last week. We had a really good conversation about that. And I shared actually how to search for these things because this is kind of a topic that a lot of people are not actually doing, but you can actually search for assumable loans that you potentially can assume just going on Redfin, Zillow, Realtor.com. And I shared how to do that in our previous live stream. But that was an hour long. I know not everyone has that time. So maybe I'll make a separate video about that, how to search for these things. I actually found, or actually searched for it going on to our local MLS in Sacramento, actually the greater Sacramento area, which is around 1 million people. And I think there was only 8.
Like 5 to 10. Yeah. Something like that.
Yeah. Like there's like 5 to 10 houses that I found that have an assumable mortgage.
And you also looked at Realtor.com and another site to be able to look for those features too, right? You're able to do that pretty easily.
Yeah, exactly. I should how to do that, but maybe I'll make a separate video about that. I just talked to someone yesterday who was a subscriber on the channel and was interested in trying to figure out how to buy a house. And he was looking at, payments and rates and prices increasing over the past 4 years. And we talked about how to assume a loan as well, which is one of the things you can do, but kind of challenging. Yeah. Cindy says, don't be a wimp, Jason. 100,000 on your forehead or nothing. Yeah, that's right. That's funny. Anyone else has any questions, just put question in caps and we'll do our best to answer those. We're going to hop off here in about 5 minutes. Okay, thank you. JBF Alaska, this is the best real estate cast by far. I tried many and always come back. Thank you very much.
Thank you.
Appreciate that.
It's really kind.
Absolutely. Yeah. If you guys have any other, I guess like requests for future live streams as well, because this video is not for Jim and I, it's for you. So if you guys have any suggestions about future videos that you guys want us to make, you guys all know I make videos about the housing market. It's basically like a housing market news channel now, but I would love to incorporate, tips and tricks to buy houses, get yourself ready, basically buying a house 101 videos. So if you guys are interested in that, please leave me a comment below on that as well. Caleb Smith, he has almost as big muscles as me. My angel hair pasta over here. Question, looking to buy in Elk Grove. Where do you see this market in 10 years? I'm thinking up. Yeah, so my advice for anyone's buying in Elk Grove, anywhere in the US is that in general, as long as you buy and hold for the long term, I always recommend don't buy a house unless you plan to own it for at least 7-10+ years. In general, historically speaking, you should be able to ride the ebbs and flows of the housing market. So where I see the housing market in 10 years, I mean, gosh, who the heck knows? But I would imagine prices will be higher in 10 years compared to what we're seeing today. TJ, Jason has always had the best YouTube real estate channel. Thank you so much. I mean, so much goes into making these videos, but I actually love them. So appreciate that. Angel Pasta. Yeah, I am not a muscular dude. My Jim and I, we haven't done triathlon in a long time. Jim, when was the last time you did a triathlon?
2004.
Oh,
Treasure
gosh,
Island
okay.
one. The one
I had
Treasure.
last time I did a triathlon was probably 2013. It's been a long time.
Yeah.
I've done 75 of them. I was like, that was my, I lived and breathed triathlon for about 10 years.
The best part of the triathlon was the beer at the end.
Caleb, I'm holding. Love your channel, Jason. You're great. Thank you, Caleb. Appreciate that. Oops, I just clicked on the wrong one. Here's Cindy. Vids are on new home building 101, like how to not lose your shorts in the design center. Oh my gosh. Yeah.
A big thing on that, by the way, the design center, that's just to mark up the prices so that they can get a higher price point on the next phase release for builders. So they give you the base price and then they start throwing incentives in there because they want that transaction amount to be higher so then they can justify their next price range.
I actually have never thought about that. You must have an MBA or something, Jim.
I bought a couple houses from builders. That's all that is.
Oh, have you really?
Hard knocks. Yeah. School hard knocks.
Yeah. So the builders will get you if you put a deposit down on a dirt lot and you want to buy their base model. I mean, chances are you're going to pay for some upgrades. And those upgrades can be hundreds of thousands of dollars. You can have a $400,000 base rate and buy a $700,000 house. I mean, literally, there's so many upgrades, and those upgrades, by the way, you pay property taxes on, right? Buying a $400,000 house, increasing that to $300,000 to $700,000, you're paying property taxes for those upgrades.
And the builder is not paying the property tax on the higher price point. They're actually selling it to you at the base rate, and then those things are improvements later on.
Oh, really? Interesting. So it's a tax advantage for them.
They avoid transfer taxes by doing that. Yep.
Oh, there you go. All right, cool. Topic, empty homes not for sale. I've seen them. All right. Let's see if there's anything else here. Bruce Lee. I guess Bruce Lee wasn't very like muscular, was he? But I am no Bruce Lee, that's for sure. Let's see if there's anyone else has any questions. We'll wrap this video up here. Jim Black, here's a self-promotion, maybe. I don't know. Does Jim
Wow,
Black
yeah, I'm Mel on my screen right now, so thank you. I'm season. I'm building out my channel, so next time we do this, we'll have my channel built out. I'd love to have 1 billionth of Jason's followers. So next time when we get this set up, love to have you guys like and subscribe. We'll have some fun stuff. We'll tell stories about loans and strategies there. Again, not to take away from Jason and all he's doing, but maybe it's a compliment. So thank you so much, Mel. Appreciate it.
Yeah. Good question, Mel. Yeah. And I'm going to help you, Jim, build out your YouTube channel, buddy.
Thank you. I'm going for 100 subscribers.
There you go. Hey, that was my goal. I started with 1 subscriber, and that was myself. And then you joined the family, and then my wife eventually subscribed.
Yeah.
Dooley Bully 916 from Sacramento. Awesome. Thank you for hitting the like button. Appreciate you. Yeah, condensed version. I think people are talking about the assumable mortgage. Maybe I'll make a video about that. Maybe I'll do that tomorrow. Because there's a lot of nuances regarding that. We'll have to hop off here in 2 minutes here, but MVD reports question. I'm still hearing of multiple offers on single family houses. There doesn't appear to be anything the Fed can do to get average home dollar money to actually fall, for home prices to decrease. I don't see prices falling. Do either of you? In my opinion, it'll depend on the direction of mortgage rates and inventory levels. So far right now, we're seeing inventory rising, but it's not absolutely skyrocketing. And on top of that, we have still high rates, but we're not seeing a huge decrease or increase in rates. We're kind of this high level environment right now. So yeah, I don't see a whole lot of out there, except for Florida and Austin, Texas, some markets where I really think they're going to see prices decrease due to inventory skyrocketing there. If you guys missed my video the other day, take a look at that. Yeah, every Tuesday, Jim and I will do this video for you guys. Hit the like button. Let's see if anyone else has any questions. Travis, USDA does not have mortgage insurance. Really, it's a guarantee fee. It's very low. I don't know. I don't do any USDA loans.
And that's because there's an element, Travis, of agriculture in that product, right? There's a lot of people that may be small business farmers or areas that have agricultural elements. So that's the government's always trying to spur extra supply of, non-durable goods, basically anything we need that's, food and shelter.
Cool. Cindy, thank you for joining us. We'll wrap this video up here. Leave us a comment below with any future live streams you guys want us to do. MVD reports, appreciate all your questions in this live stream. Appreciate you too, Supreme Action and Todd. Thank you very much,
remember, if you guys want a total cost analysis, reach out to Jason on your scenario. Happy to provide it. It doesn't take too much time, and let's make something, get you guys more information that you need for your specific situation. So happy to help.
Yeah, I'll throw out my email address, which is jason@meetjasonwalter.com. Thank you, F Sharp 357. I appreciate you. Jim, thank you so much for joining us. Appreciate you, buddy. Hope you have a good evening. And everyone watching today's video, please like and subscribe, and we'll see you on the next video.